There is one number that explains every single dollar the ultra wealthy spend without ever paying tax on it. It is not their net worth. It is not their tax rate. It is the gap between what borrowed money costs them and what their assets earn them while they hold it. Get that gap right, and you can legally spend millions of dollars a year and owe zero income tax on any of it. By the end of this video, you will not only know exactly how this works, you will know exactly why it is completely out of reach for almost everyone watching, and exactly what the small, honest version of it looks like that you actually could use starting this week. Financial advisors call the full version buy, borrow, die. It was formally described by law professor Ed McCaffrey in the 1990s, and it has quietly become the backbone of how a huge amount of American wealth avoids tax entirely, not through anything illegal, but through three ordinary rules stacked on top of each other. Here's the setup. Under normal tax law, if you own stock and it goes up in value, you only owe tax the moment you sell it. That is a capital gain, and depending on how long you held the asset, the rate can run 15 to 20% or higher. Sell $5 million in gains, owe tax on that $5 million. Most people accept that as the unavoidable cost of accessing their own wealth. The ultra wealthy figured out you do not actually have to sell. Step 1 is buy. You own assets that appreciate. Stocks, a business, real estate. On paper, you are worth a fortune, but paper gains are not taxed. Only realized gains are. So the first rule is simple. Do not sell. But you still need money to live on. So step 2 is borrow. This is where the mechanism actually lives, and it is called a securities-backed line of credit, or SBLOC. Think of it like a home equity line of credit, except instead of your house, you use your stock portfolio as collateral. You borrow against the value of your investment, and the bank hands you cash. You never sold a share. The stocks stay invested, still compounding, completely untouched. Here's the detail that makes the whole thing work. Money you borrow is not income. The IRS does not tax loans, so you can borrow millions against your portfolio, spend it on a house, a business, anything at all, and owe zero income tax and zero capital gains tax on that money. Not a loophole snuck into the code. Borrowing was simply never a taxable event in the first place. Run real numbers. A $10 million stock portfolio. Most SBLOC lenders let you borrow 50 to 70% of that value. That is $5 million to $7 million in spendable credit without touching a single share, while your $10 million keeps growing in the market exactly as if you never touched it. Current SBLOC interest rates run somewhere around 5.5 to 6.5%, with the lowest rates reserved for the largest portfolios. If your assets are growing at 7% a year and your loan costs you 6%, you're still coming out ahead and you paid zero tax to get there. This is publicly documented, not rumor or speculation. Elon Musk has used his Tesla and SpaceX shares as collateral for loans worth billions of dollars. He did not sell Tesla stock to buy Twitter. He borrowed against it, kept every share, and never triggered a taxable sale. There is a second version of this strategy that works even more aggressively, and it uses an account most people already have sitting in their name, a Roth IRA. In 1999, PayPal co-founder Peter Thiel used a self-directed Roth IRA to buy 1.7 million shares of PayPal founders' stock at a tenth of a cent each, a total investment of $1,700. When eBay acquired PayPal in 2002, those shares were worth over $55 million. Every single dollar of that growth sat inside a Roth IRA, completely shielded from tax permanently, because that is simply how Roth accounts are designed to work. By 2019, ProPublica reported that account had grown to roughly $5 billion. Not fraud, not a secret account. An ordinary retirement account rule applied to an extraordinarily early stage investment nobody else had access to. Now, here is where most videos on this topic stop and just tell you rich people do this, which makes it sound mysterious or hidden. It is not. The SBLOC route is publicly available to anyone with a large enough brokerage account, but it carries real risk that almost nobody explains properly, so let's actually walk through it honestly. Borrow $80,000 against a $200,000 portfolio. That is a 40% loan-to-value ratio, which sounds conservative. But markets fall. Drop 35% during a downturn, and your $200,000 becomes $130,000. Your loan is still $80,000, but now it represents 61.5% of what your portfolio is worth. Most lenders set their danger line right around 60%. Cross it and you get what's called a margin call. Deposit $20,000 in cash immediately, or the bank sells your holdings itself to bring the ratio back down. And it will sell at the worst possible moment, during the crash at the bottom, locking in losses you never chose to take. This is exactly why wealth advisors give one very specific rule. Even though lenders will often let you borrow up to 60 or 70% of your portfolio's value, the actual professional recommendation is never more than 25 to 30%. That buffer is the entire difference between using leverage successfully and getting wiped out by a single bad quarter. Now the third word, and the part that turns this from a clever cash flow trick into a genuine tax elimination machine: die. When the original owner of that portfolio eventually passes away, their heirs do not inherit the original cost basis of those shares. They receive what's called a stepped-up basis. In plain terms, for tax purposes, the shares are treated as if they were purchased on the day of death, at whatever their value is that day. Every single dollar of growth that happened during the original owner's entire lifetime, decades of compounding, simply disappears for tax purposes. The heirs can sell the inherited stock and owe capital gains tax on essentially none of that growth. So walk through the full life cycle. Buy assets that appreciate. Borrow against them instead of selling, so you never trigger a taxable event. And the assets keep compounding untouched. Spend that borrowed money on your actual lifestyle tax-free, because loans are not income. Die. And the unrealized gains vanish for tax purposes the moment your heirs inherit them. At no point in that entire cycle did anyone pay capital gains tax on the growth. Buy, borrow, die. Here's the honest part: most videos on this topic skip entirely, and it matters. Research from the Tax Policy Center found that if buy, borrow, die were genuinely the dominant playbook among the ultra wealthy, they would be borrowing aggressively against their portfolios at scale. Mostly, they are not. The data actually shows that borrowing against unrealized stock gains is, if anything, more common among upper middle class households than true billionaires. Most ultra wealthy people fund their actual day-to-day lives the far more boring way, through taxable salaries, dividends, business income, and interest, spending less than they earn and reinvesting the difference. The strategy is real, and it absolutely does shelter enormous sums from tax. The top 1% alone are estimated to borrow over $1 trillion combined against unrealized gains. But it is one powerful tool in a much larger toolbox, not the entire explanation for how the wealthy live. And here is exactly why this stays out of reach for almost everyone watching. And it's not because anyone is hiding it, it is simply inaccessible by design. Most SBLOC programs require a substantial minimum account balance to even qualify, often measured in the hundreds of thousands or millions of dollars. No large portfolio sitting in a brokerage account means there is nothing to borrow against in the first place. The Roth IRA version requires access to extremely early stage, high growth private investments that most ordinary people will simply never see. None of this is illegal or secretive. It is structurally unavailable to anyone who has not already accumulated significant assets or opportunity. But here's the piece that actually applies to you regardless of your bank balance, because the underlying math is identical at any size. The entire buy, borrow, die strategy runs on one single question. Does what you do with borrowed money earn more than that money costs you? That question does not require a $10 million portfolio to be useful. It applies the moment you carry a credit card balance at 24% interest instead of moving it to a 0% balance transfer offer that only costs a 3% upfront fee. Run that math. You are renting money for roughly 3% total to escape a 24% rate. That gap, applied to your own debt, is the exact same spread this entire video has been about. It also applies the moment you improve your credit score, because your score is the single biggest lever on what every future loan costs you for the rest of your life, and unlike picking the right stock, that number is almost entirely in your control. So here's what to actually do with everything you just learned. Pull your credit score this week. Know exactly what your money costs you right now, because every point you raise, it lowers the cost of every loan you take for decades. If you are carrying high interest debt today, check whether a 0% balance transfer offer beats what you are currently paying. That gap is not a billionaire's tax strategy. It is the same math sized down to fit an ordinary life. None of what you learn today requires breaking a single rule. It only requires understanding the difference between what money costs and what it earns, and applying that at whatever scale you actually have. That is the real barrier between someone using this strategy and someone hearing about it for the first time. If this changed the way you look at debt, loans, and where wealth actually sits untaxed in this country, that is exactly what this channel exists to do. Subscribe, because next week we are breaking down another system. Most people never get explained to them clearly, and it connects directly to everything you just learned here.